Ladies and gentlemen, welcome back to the Capital Flows podcast. I want to cover several things on the Substack that have been published and some of the views that I've been laying out. The first one is in this top panel, the macro regime tracker is the systematic breakdown of all of the major signals and tear sheets and everything that I watch every day that I lay out. That's sent out every single day on the macro regime tracker. If you go to the most recent one, there are, well, this will be in all of them, but if we're going to go to the most recent one that breaks down what we have been seeing taking place, I've laid out the alpha report for how to think about the pricing of a July cut. If you are thinking about interest rates at all, or if you're trading equities at all, understanding that July cut is going to be important. And then on the section here for the macro tear sheets, there are tear sheets on every asset class: crypto, fixed income, equities, FX, and commodities. These just break down all of the major changes that are taking place. What I want to do is go to the fixed income tear sheet. And if you go to this tab or if you download the tear sheet for fixed income, the thing that I want to focus on are the central bank meetings and how that connects to interest rates. So when we think about macro and the catalysts that we have, we are functionally always moving from catalyst to catalyst that is either disconfirming or confirming the expectations of the market. So when we move through a CPI catalyst, an FOMC catalyst, all of these different catalysts are laying out the confirmation or falsification of what the market is implying. Right now, we have 29 days before the next FOMC meeting, 15 days before the next Bank of Canada meeting, and then 16 days before the next ECB meeting. Now, those are important because depending on how much you're mispriced in an asset, let's say in the forward curve for the US, the more you're mispriced and the greater period of time that you have between the next catalyst, you can have some really interesting moves. And so that's an important thing to be aware of, to say, what are the returns that are taking place? What's the volatility? And then how does that connect to the amount of time we have in between catalysts? And how are we going to move until we actually have real hedging pressure through something like NFP, CPI, FOMC, anything like that? All of these main funds, especially equity funds and any type of long-short fund or whoever they might be, they are hedging out the macro risks that they have. That's one of the reasons why you have hedging pressures through these events. It's because people want to be market neutral moving into them and then they come out of them. So for the US curve, I want to go over several key observations for the US and how to think about the pricing that we have. Right here in the boxes, you can see how many basis points of cuts are priced for the contracts as we move down the calendar year. December 10th, 2025, that is the pricing for how many rate cuts we're going to get between now and the December meeting. Right now, there are a total of 53 basis points priced. Now, I don't think we're going to have more than 75 this year. So that's, in my view, setting some pretty significant, resistance in how ZT, ZN, all of those bonds, or all of those instruments are being priced on the short end and the long end. For the ECB, the interesting thing is that we are now pricing 22 basis points, almost 100% probability of a cut in June. Now, in my view, the ECB is cutting, but they probably shouldn't be. There's maybe a little bit of a coin flip about how you interpret that exactly. But in my view, they shouldn't be cutting because they're already having their stock markets, their respective stock markets, Euro stocks, the DAX, the stock index in Italy, all of those major indices, they've already pushed to all-time highs, and the US is actually lagging behind. On top of that, you have all of the banks in each of those countries rallying, meaning if you have the financial sector in a country rallying, it's because they're issuing debt and they're making fees. That doesn't happen in a recession, right? That happens as you are having melt-ups and nominal GDP is rising, because banks have the clearest view into lending standards, the amount of delinquencies, and the information that is taking place in the macro economy. And so in my view, the setup that we have is bonds will continue to sell off. We might have a bounce or something like that if that July rate cut gets priced in for the US. But broadly speaking, I think, especially watching Germany very closely in their long duration bonds, that's going to be a key signal along with the yen during the Asia session, how exactly we're likely to price things. On the Substack here, the final thing I want to cover is the educational primers are all right here in the main tab, in this main pinned article. If you scroll down to the very bottom here and you go to the educational primer section, these lay out every asset class and how to think about them. And then if you're trying to understand what I was talking about for hedging pressure, catalysts, and those types of things, the type of logic you want to think about when we're moving through those periods of time, go through all of these primers and then watch the respective podcast video that I do for each one, breaking it down further.